So we're back with the commodity report, and there's been a lot of trends that have been happening, starting, ending. Basically go across the board, and you can see a lot of things happening. So looking at the charts today, crude oil down 4% today. Breaking down, we were talking about that chart a while ago, and it's kind of you have this massive squeeze pattern in crude oil. It's going to either break up or down. And we could make a thesis for it either way. And most of the time when that happens, I really want to follow the price action. So right now, crude breaking down, getting past some major levels. So it's breaking out of that triangle pattern, breaking down. It's going to be a short now, something that hasn't happened in a while for crude oil, for me at least. And then if we're looking at across the board, something that's also been interesting is wheat's really been holding up well. Wheat kind of basing out, kind of seeing this little breakout pattern that's kind of starting to happen. Granted, it isn't a major breakout, isn't a major trend change, but it is something happening in the ag space, which hasn't happened in a while.
Yeah.
And then if we go through the performance, basically year to date, we're seeing orange juice up 54% year to date. Coffee, which hit a new all-time high, well, not all-time high, sorry, a new 10-year high, I think. I think it actually hit a high back in 2012, 2011-ish. But coffee's up 37% year to date. Gold up 15% year to date. Silver up 11% year to date. Hogs up 10% year to date. I mean, kind of across the board, we're seeing a lot of major positions and major trend changes here, to the upside and the downside. Crude oil, even it's still up year to date, but it's definitely starting to break down now. And then if we go just at a 1 month performance, the shift of things have been pretty amazing to see. And one of those things that I've been keeping an eye on is the commodity currencies like the New Zealand dollar, the Canadian dollar. Kevin and I have been talking about the Canadian dollar for a bit now. Kevin actually had a really good report recently on the Canadian dollar. Seeing those major breakouts in the Canadian dollar finally start to happen, and this move start to happen after this extreme commercial buying that we've seen in the Canadian dollar. Most of the time when you see that type of commercial buying, you'll see a short squeeze start to happen. So seeing that happen in the Canadian dollar, pretty wild to see, something to continue to pay attention to if this is going to be where the commodities are picking up, or at least the dollar's breaking down to that extreme level that some of these currencies are starting to catch a bid. But seeing the New Zealand Kiwi up there, it's pretty interesting. So Kevin, what are you seeing across the board? We're seeing so many things in these markets at the moment. I know you've got a lot of ideas here. So what are you thinking now?
Well, what I'm thinking is like we don't broadcast for 1 week, and things are changing. So I'm glad to be back. This is actually one of the most favorite things that I have on my calendar every single week here. All right, let's talk about. We broke a lot down. One, I want to kind of highlight gasoline did officially cross the $2 level. Now it's bouncing back here a little bit, but that's huge, to say the least. Here we already talked about crude oil. Look, so for the crude oil space, here's the fundamentals that are taking place right now. You have a situation where there's reports from Reuters. This came out Thursday or Friday of last week, that OPEC plus is actually 6 members of OPEC Plus are still looking for to increase production starting in October. Now, we don't actually have that meeting until October 3rd, I believe. That's when we'll get the official decision, but we'll start hearing some things trickle out. One thing to just note, though, news reports can be wrong, and they often are wrong when it comes to OPEC Plus. Okay, so there's a lot of influence, there's a lot of things happening behind the scenes that some members may do in order to try to shift policy, even though we have not heard from the major players. And the major players that we really care about is going to be Russia and Saudi Arabia. Those are going to be the two, in the UAE. Those are going to be the three that you really kind of want to focus on. They command policy right now. And so that news, along with the fact that Libyan oil, this is where we saw a little bit of a pop last week. So in Libya, they were planning on reducing, actually eliminating their exports and stopping all production because of some internal political issues that are happening between the East and West. They have like a weird thing where they have two kind of governments that are running. But today, the other reason why we're seeing a sell-off in crude is that we might be seeing some bright signs that they might be resolving their issue. So If you break all of that stuff down and you bring them all together here, you have increase in production from OPEC, which kind of the market was under pricing in just because prices just have not sticked. And then you also have the potential for Libya to kind of find a resolution. And if that's going to be the case, then you're going to have more oil supply in the marketplace, and then you're going to have prices being, depressed here. I just got off of a space where I was saying from a technical standpoint, 70.5, you could see some buyers kind of stepping in. We might be seeing that happening right now. It's just trading at around $70.80 if you're looking at crude. But we can't deny that the downtrend for oil right now is definitely intact, and we're on the horizon of potentially breaking the 70 level. And if we do break the 70 level, the key area of support is going to be $67.48, $67.50. So that's kind of where we are at with that. Gasoline continues to just get destroyed. Heating oil actually saw some pretty decent bright spots last week amidst some of this selling pressure that we saw from crude, but now that's to the downside too. So from the energy complex, just when you're looking at the crude oil as well as the byproducts, there is definitely bearish for now until we get better macro data, and the data points that we've gotten from the United States just today alone, when you're looking at ISM manufacturing, is not going to really get us there. So that's what I'm looking at when it comes to the oil complex. You never want to get in front of a moving train. So it's hard to really kind of call bottoms here. But I would just kind of put in the back of my mind here that Reuters report regarding OPEC I'm not saying it's not true, right? But we don't know if that's going to be a definitive go, no go right now when it comes to production. And if that is going to be the case, I think that has wider ramifications, and that's why I don't want to get ahead of this right now. But let's just map this out here real quick. If they are going to increase production, and this is the route that they're going to start going towards, even though prices have slid, I get then a little bit more concerned when it comes to shale production here in the United States. I get more concerned of a 2013, 2014, 2015 type of scenario where you now have the players, we'll call them in the East, right? Really trying to pressure the shale production that we've had here in the United States, trying to squeeze margins, and then also then making it not profitable. Because if you're looking at 3-2-1 crack spread, I haven't looked at it this morning. Actually, I'll bring it up. But last week it was sitting at around $19. A month and a half ago, we were looking at that being around $25, $26, if I'm not mistaken. So more production online can actually decrease that crack spread. That crack spread is how we measure margins. 3 barrels of crude making 2 barrels of gasoline, 1 barrel of diesel or heating oil. That's just a rough metric. There's like 20 different crack spreads that are out there. But that's where I get a little bit more concerned, where we could have more downside pressure. Is this a policy shift? And is OPEC ready to kind of, I'll say, go toe-to-toe with shale production once again? We're going to see the same type of ramifications like we saw in 2013. And I don't think that's a good thing, because even like 6 months, 8 months after that, that's when we saw a broader equity, sell off. So that's where I'm at.
Yeah, no, I mean, it's one thing with OPEC, and generally this is just with most economic data, most economic releases and so on, is that we do see these things happen from time to time where they come out and they say a certain thing and the forecast is one way and it changes. And with OPEC, that happens a lot, where it's a political chess game. Let's be honest here. And as they're playing chess, part of that is that at certain points they want to hold let's say it's poker, more like poker. They're trying to hold what they have, not let their hand be known to their opponents, and this happens from time to time. So I also believe with you that it's a tough one here to say like, hey, oil's going a lot lower here. I'd be surprised, because right here's a pretty good spot. We do have a lot of support here as well. So once again, it broke down from a major pattern, and you want to pay attention to that. And if we're kind of in the environment where growth is actually slowing and bonds are going to continue higher, and this is kind of be the new regime that we're in, sure, oil's not going to do well in that environment. But will it continue to break down from here, get all the way to 50 and so on? I'd be surprised. I'd be very surprised on that.
We would have a bigger problem.
Yeah,
It would be a bigger problem than just the energy complex in general. It would be the rate of change of that too. So yeah, I don't know. I don't have really an edge when it comes to OPEC. You know, like I said, like you said, it's politics, right? It is a cartel. Everybody, you know, is probably the biggest legal cartel that is out there. So you know, you gotta take it with a grain of salt. But you know that a lot of the smaller members are upset because it's impacting their GDP. I mean, when you're looking at 85% of your GDP as a smaller country is selling oil, and everybody else is telling you don't do it, don't sell, you know, it's going to piss you off at some point. And so that's kind of where we're seeing kind of right now. Yeah, it's not a good look. And actually, there is a technical downtrend that is taking place, right? Making lower highs, lower lows right now, and we're kind of reversing. Now, I would say, you know, if we're, let's just say cruise flat on the year, it's, you know, that is tough. But you're right. There is some buying structure. Once again, 67.50, 67.71 was the lows that we saw in December. Yeah, this is it's tough. It's tough. There's a lot of short sellers into this too. I don't think this is all straight up, you know, fundamental, clear, like price action that the market's freaking out. You're seeing a lot of short activity taking place. And then when you see these strong recoveries of $2 or $3, those are the short sellers buying back too. So, you know, you got to be very nimble when it comes to this contract. If you're looking at risk reward, upside risk to reward, could you make a play here from a technical standpoint? Not a recommendation. Yeah, you could. You have a tight stop. I mean, I want to say tight stop. If you put a stop out there, say it's 69.5 to kind of play that downside risk compared to where it's at right now. And let's say you have a retracement back up to 74, which is literally where we were trading on Friday. You know, you have the 4-to-1 risk ratio. You know, could take a stab at it, but it's tough.
Yeah. I mean, I think in general, it's the short term. If I give my view, and then let's say over the next 2 months, and it's something I wrote about the other day on my Substack. If you guys check that out, you guys can subscribe. We put out a lot of free stuff as well, so you guys can all check that out. But if I was putting out my view the other day, basically looking at it and going, okay, over the next 3 months, let's say, not even, probably September, October, I would say the energy market's probably in a tough place. If we're looking at oil, we're looking at gasoline, like could be in a tough place coming into the election, a lot of volatility coming into play. Markets could be under some pressure. I mean, there's a lot of things to a lot of reasons to say, hey, maybe I'd like bonds here over oil. But after that, I think that there's a really good setup that is building. It isn't exactly here yet, but that setup is building for a end of the year rally in things like oil, gasoline, and the energy markets. So right now, I think it's a good idea to kind of just understand, hey, like, you know, maybe this is just going to be full of chop. Maybe this is going to be a rough trading market. Maybe something like Kevin said is the only real trade you do have, which is look for some bounces. Look for some shorts within a range. Look for some bounces within a range. But really getting into the end of the year, this is when I'd really be looking for that major trend change. You know, look for it to get up and over some major moving averages. Look for it to get over make a 100-day high, something. And then possibly go, okay, we have a nice end of the year rally. So, you know, this is just a bunch of different ways to look at this tactically so you guys can trade this market.
Hans had a question I saw yesterday night. Right. Yeah. So let me, so the question, and I'm going to paraphrase it, right? So the question is, okay, you know, KG has been talking about these base effect situations that were going to take place when it came to inflation. And what does that kind of look like moving forward? So let me kind of clarify. So I was actually talking about the August and September data set being favorable for CPI, which it is. You know, that, you know, everybody's like, oh, look, I just told you so. Like, literally been talking about this since like February of this year. You're going to see very favorable comps for the energy component of CPI. for this August. When I say August, September, August data set, we're talking about what's actually happening in August, which is going to be then reported in September, and then what happens in September, which is going to be reported in August. You're already seeing that base effect taking place with the July data set, which we had from CPI. So it will be favorable to a point. Now, if you kind of look at a chart for November and December of last year, this is where we kind of get to equal levels, right? So this is where the comps get a little bit more difficult. And then going into next year, if you're looking at going into next year, what you really kind of want to be focusing on, especially when you start off the year, is if we can kind of stay below the $74 level for oil. And that would be, once again, kind of favorable for the Fed at the moment. The problem that you will have, and the Fed will have, is going to be the comps for gasoline, because we have such short positioning taking place, aggressive price action taking place. I mean, gasoline, guys, is literally, we're trading close to, and actually we did trade today, pretty much the December lows from last year. Last time that we saw levels like that was in November of 2021. Okay. And we're just ending Labor Day. Like, we're not even at like the seasonal lows that we typically would see for gasoline. So that trajectory is still to the downside, right? But then you have an issue with short covering rallies that take place, disruption in logistical lines. I mean, those are the type of scenarios that you have these rapid adjustments to the upside that can impact month over month comps for inflation, and that could be a problem. So we have very low basis for energy right now. The trend is still downward, so you don't want to fade. You don't want to try to catch a falling knife there. But you do have a scenario where all you need is all you need is a logistical adjustment, and that's where you can see a pop back to the upside. So comps right now, year over year, from an energy standpoint, is still favorable for the Fed until you get to around late December, January, and February next year. And with that, I'm pretty sure Jason may have had some issues here. So let's kind of talk about another market that we'll get into here is going to be wheat. And so, Jason, I went back and just kind of talked about wheat. So you talked about the wheat market earlier. We are seeing a decent little bounce here. Now, if you kind of look at a weekly chart and you kind of take some time back, I mean, obviously wheat prices have just been consolidating and just been continuing to move to the downside. But you are at a structural area of support. Basically, what I had as far as the range is 560 top side, 530 for the downside here. We actually breached through that, hit 500, and now we're seeing maybe some short covering taking place. There's also a little bit of concern when it comes to yields and what you're actually able to produce on the wheat market for harvest, as well as potential disruptions when it comes to the Black Sea. There was a report out that now Black Sea shipping rates are actually close to mirroring the increases that we've seen from the Red Sea. And if that's going to be the case, then obviously that's going to be a geopolitical risk premium that's being put into the marketplace. So I think you're getting a little bit of short covering taking place there. Downtrend is still to the downside. Corn up around 1% today. Once again, I think short covering event that's taking place. And then you have beans, which is catching a bid. You generally do not start seeing harvest time bounces until pretty much like the last week of September and then the first 2 weeks of October. And what does that mean? Once we start the harvest season, typically you'll see those short sellers starting to buy back their contracts, because you never know what actually happens until we have all of these estimates, but you could harvest and the bean size for soybeans could be a lot smaller than what the street expected. You could have excessive rains for the 2 weeks while you're harvesting. Like, all of those situations can impact it. So usually you get a little bit of a bump for harvest. And then once we get done with harvest, or pretty much 80 to 85%, then you kind of start to level out here. There's also concern about Brazilian production and if they're going to meet the expectations that the market has. And from what we've seen as far as estimates over the last week and a half, that might be in doubt. So I think that's another area that's probably seeing grains move to the upside, and then export demand has increased. The dollar moving to the downside has now made it where grains look a lot more attractive for China to buy for us right now. And if you're looking at Brazilian inventory levels, they're actually relatively low. They pretty much have sold out of their inventories for this year, right? And now they're going to have to start selling new crop commitments. And so if that's going to be the case, then we should see a bounce when it comes to export demand. And we have seen that over the last 2 weeks, actually the last 3 weeks, but I would say the last 2 weeks have been really solid when it comes to export demand for corn and soybeans. What are your thoughts?
No, I agree. And yeah, sorry about that, guys. I have no idea. Every time I try to click on my market data, it just shuts down my Google Chrome. So I've got to figure that out later. But when we're looking at the grains, I think the thing that's sticking out the most to me right now, one is we've had the idea, like the setup's been there fundamentally for a while. Like Kevin and I have talked about this over and over again, basically trying to say like, hey, like the setup for these grains, it's here, and it has been here for a while. And we continue to look at it, continue to see this great setup. However, we've been waiting for the price action to start to match. For me now, we're kind of seeing the price action match. Wheat, especially for me, has been the big one. That's the one I'm the most bullish on is wheat. Out of any of the other grains, I continue to look at the wheat market and go, that's a setup of a massive rally, a massive trend change could happen any day now. Finally, we're starting to see it start to make some 50-day highs. We haven't seen that happen in a long time. Basically, this market's been in a tough downtrend with a couple bounces over the last, since 2022, basically. So as we continue to look at that, like right now, I would say like, hey, it's the time to start maybe taking a position in wheat. Start to look at this thing as a possible trend change beginning, but also like Kevin said, I would continue to understand that. And this is part of the reason why I kept saying like, hey, it might be at the end of summer, because the seasonals are pretty bad from basically, May all the way into August. They're pretty bad for wheat, pretty bad for corn, pretty bad for grains in general. But now if we're looking at it and going, okay, well, we are in a little better seasonal period, I would continue to take buy signal, because seasonals to me, it's a general time frame. So what Kevin mentioned, going, hey, it's the end of this month. It could be the beginning of October. For me, I would say I want to be taking buy signals, and this is not to say what Kevin's saying. Just what, in my opinion, what I usually take from seasonals is from this time into October, I would be open to taking buy signals, because sometimes the market front runs these seasonality. Sometimes the market is late or completely ignores seasonality, which is also a good signal to pay attention to. If it doesn't really catch a trend here, that would tell us something. But if it starts to catch a trend here, I would say, hey, we're following the seasonal pattern. We could see a nice little rally in wheat and continue to take those trades. But I do like this sector a lot. But wheat's my favorite in it. What's your pick? What would be the one you would say is the one people should keep an eye on here, Kevin?
Oh, man. That's a tough one. That's a tough one, man. I think the export demand for soybeans is obviously going to probably be the biggest driver when it comes to prices. But we also have to note too. So what we planted this year was actually over the estimate because we kind of had a late planting cycle for corn. So on the other side of that, I'm like, well, maybe corn is a decent one, but the problem that you got with that is if you're having lower energy prices and potentially lower energy demand, you don't have the ethanol side for corn. And then for wheat, so for those that don't know, wheat is grown literally like year round. Like you could pretty much grow wheat all the time. And in fact, I think we pretty much, for the most part, have 3 main cycles here in the United States. Now some of that's going to be like Minneapolis wheat, which is more of a refined wheat that's used for like artisan breads and all that fancy stuff. Like we don't export any of that Minneapolis wheat, right? We export the Chicago wheat. We export the yeah. So wheat is more like if I thought there was geopolitical risk, like that would probably be the play. But you also kind of once again understand the fact that it's pretty prevalent as far as growing seasons. And then also you have to think about India. And so is India going to be a huge driver or a draw on international markets? So India is a huge producer of wheat, but they actually consume literally all of it. They don't export pretty much any of it. And what we saw earlier this year is that their monsoon season wasn't as aggressive, which kind of put at risk wheat production, and then the risk of them actually having to go to the international markets to be able to purchase. Doesn't seem like that's the case right now. It seems like their monsoon season is doing fine. So each of them has like their bright spots and then their lagging points. So I can't see like which one's like absolute favorite. I would say like the one that's going to gain you the more headlines right now is going to be export demand, and that should come from China, and that'll be in the form of soybean meal as well as soybeans. Knowing the fact that inventory and production levels are probably going to well exceed the USDA's expectations this year, like you got to go into it thinking that's going to happen.
So this also brings up another conversation which I had online the other day, which is, it wasn't a conversation about commodities, but we can tie it into this idea that we're talking about today, which is, basically the question was, what do you like better, gold, silver, or bonds? And for me, like as a portfolio manager, I'm like, well, I would take an allocation. I would build it a certain way. I would take my biggest position in bonds because it's the lowest volatility product. I would take my next biggest position in gold because it's the next lowest volatility product. And then I would take my smallest position in something like silver. And I would have all 3 of them, understanding that the alpha of these things can, the alpha of silver could generate a major return, but also it could, let's say we're in a different environment. Let's say we're more of a risk-off environment. Silver's not going to do that well, but bonds would do well and gold should do okay. And so I had that conversation, and sometimes people go, well, I don't have enough money to do that, and so on. And really, it's like, once again, it's not you can't think about how much money you can make on that one big trade. That's how people get into trouble. Trust me, I wish I understood which trades worked. Like, I wish I could look at my whole system and go, okay, if I take these specific 2 trades, these are the working trades out of my 20 trades that I have on, and I'm only going to take these, and I'm going to dump more money into it. That'd be great. It just doesn't work out that way usually. So you kind of have to have a little bit of diversification, but doing this type of diversification in some way that you're diversified across a sector, something that's highly correlated, like you can create major returns on that. I mean, that's really Ray Dalio's holy grail that he calls it. So getting into the grains, I think an easy way of doing it is looking at it and going, okay, maybe wheat, soybeans, corn. I would just take buy signals as these things come in. And so take a buy signal in wheat. It's nearly here. Wait for corn, wait for soybeans, continue to buy across those things as they come up. But I think that's the easiest way to do it as a trader, especially if you're like long-term trading. If you're short-term trading, sure, like you could really pick and choose. That's fine. But if you're trading in that over a month to 3 months to 6 month time frame, you might want to have that diversification just to be across these different things, take positions as they come. What do you think, Kevin?
Yeah, I'm right there with you, right? Like,
and you're more short term, so you could speak to like even the day trading type. What do you think about that?
Yeah, I would say, you got to be very mindful. I mean, right now when you're looking at risk reward, knowing the selling pressure. Now, you are already seeing short covering taking place. Last week, we had a net change of 35,000 contracts for corn. Now, net position still negative 201,000, 127 contracts, but you're seeing that action. KC wheat, buyers stepped in, 5,358 contracts they took off. right? If you're looking at soybeans, 11,985,000 contracts. I mean, 11,985 contracts. So you're already seeing the short covering, events really kind of taking place here. I would definitely be, I would pick and choose for them. I still, once again, you don't have the export demand. If you don't have sustained export demand, it gets tough. There's nothing else that says, oh man, like buy grains here, because like the production output levels look bearish. Consumption levels look bearish. Exports are starting to gain a little bit of traction. And then you have the geopolitical risk, which is the bullish case, right? Mm-hmm. And so until one of those things actually adjusts and puts you more bullish than bearish, you got to be very tactical with it. Mm-hmm. And I think that the tactical approach right now is just to kind of play the bounces when you can, get out as much as you possibly can. And sometimes you don't even have to get long the actual futures contract, right? Like I would say like futures options spreads are going to be like your golden ticket right now. And you should be trading these contracts on all of them, right? And so that'll be your, let me not say it like that. That would be the most liquid contracts for you to be able to trade, and then also to have exposure to this market. Because if there's still downside premium being priced in, then if you had like upside call spreads, they should be actually relatively cheap. So that's how you can actually play.
No, and I agree. Yeah, I mean, you have to understand the markets you're in, and more the question for why it's bonds and gold and silver is like you're questioning three things that are kind of in a bullish trend. And why I wanted to ping this back to us is because we're questioning three things that are not in a bullish trend at all yet. Sure, wheat is kind of getting there, but the rest of them, we're still looking at these tactical opportunities. So even something like the grain market, for me, it's a, wait for, if you're a long-term trader like me, you wait for your trend change signals, you buy it, you move to the next one, like corn, let's say, is next, you buy that when the trend changes. But for now, it's a sit on your hands situation, wait for these moves to happen, and then buy them. So I want to also talk to you a little bit about coffee, Brazil, sugar. Let's look at the softs a little bit and take a little dive into these, because we're seeing coffee hitting new highs, multi-year highs here. We're seeing sugar, which also is starting to try to look like it's carving out a bottom, not quite yet. Lumber had a nice little rally, kind of interesting to see. So when we're looking at these markets, and this is a market that not a lot of people trade. It's getting slimmer and slimmer as time moves on. That I can talk to people about trading the softs. So when you're looking at coffee, when you're looking at sugar, what are you seeing here? Are you seeing any risk out there? Are you to the upside or downside? What are the exports looking like? What's the weather looking like globally? What are we seeing here?
Yes. So for sugar, we saw that pop to the upside. So there were some fires that were in Brazil that were, being suspected that they're gonna, impact obviously, production. So you saw not only just a short covering rally, because sugar has been for the most part depressed if you're looking at a longer time frame, but you also then have that near term bullish catalyst because of production issues, and so that might be short lived. So you might want to. Maybe you sell into strength there. Are you going to see an increase when it comes to ethanol demand too? Like, does sugar is also kind of utilized for that? That's another question mark. I don't have an answer for that, but that's really what's happening with the sugar market right now. It's just kind of like it's kind of like what we saw with cattle. What was that earlier this year? Was it earlier this year, like late last year, where we had those fires out in like Texas or something like that, and cattle got this huge rip. Anytime that you have supply side risk, that's what's going to drive your prices. You have supply side risk along with that significant amount of short selling taking place, a short positioning taking place. That's going to create this short squeeze there. I don't think that from a market standpoint, I don't think there's like a huge buy thesis right now. For now, right? That could always change, but for now, it seems like that's kind of where we're at. Because if you're looking at the production levels for sugar, they're actually still relatively high. We're looking at the second highest production out of Brazil in their last 10 years, and last year was the largest one. So until we get some more information as far as the crop down there, I think you kind of have to be very nimble with this one. But the bearish fundamentals are still, for the most part, intact, even though you have some bullish green shoots that are coming out because of supply issues or potential supply disruptions. Let me say that.
Yeah, I like that thought, because even for us, we had a tactical trade that was put on in that, looking for that bounce. Got that bounce, but now it's once again, the production issues when these come up, and they usually are very short lived, and that's a thing that you have to really understand. If you're buying things that are consolidating or in a downtrend, like, all you can really play for if you're a buyer is a bounce. You're not playing for like a major move or something to hit new highs. Like, you're just playing for a bounce. The trend is still down, sideways, however you want to look at it. Some people, I had somebody argue with me about that the other day, and I'm like, look, however you quantify trends is how you're going to look at that. So some people are going to be more long term, some more short term, and so on. But I really like the thought here that sugar, to me, I'm looking at the same thing. Sure, the seasonal start to pick up around now. We get into those holiday seasons, October, Halloween, Thanksgiving, Christmas. Sure, like, we can see those seasonals pick up, but that, once again, that could also just be another short-lived bounce at some point in the future. And then if we look at coffee is structurally bullish, here. If we're looking at the charts, so what are you seeing in coffee on the fundamental side, Kevin?
This one's actually very interesting to me. So we continue to kind of go back to production levels, and are we going to see, near-term disruptions? Now, the big catalyst that we've seen over the last month is that bean size for coffee, for the most part, on average, is a little bit lighter, especially when you're looking at South America. But the other side of that is actually Arabica production is actually higher, or the expectation is going to be higher than what the street's expectations were. So I think it's more of just of a blend of where production's coming from. We're going to be leveraging, Brazil and even Argentina for that matter, but Brazil mostly. Are we going to be leveraging them more rather than maybe some other players out in Africa? And I'm not sure. I'm not sure about that, but you did actually have some buying activity happening last week. Net contracts changed to the upside by 2,990 contracts. And we know that the softs, it doesn't take much to keep a trend going. And if you're kind of noticing when it comes to this conversation, we're in a weird area right now, right? We're harvesting, for the most part, for the US. We're going to be in a harvest season right now. And then when you're kind of looking at South America, it's more like production planning for next year. What can we get to? So there's not really a lot of concrete, man, this thing can continue. I mean, it can continue to run. A soft contract can run and rip face off. But I do kind of like wonder, knowing that there has been some bearish fundamentals when it comes to Brazil production, and meaning that they're able to actually satisfy demand or satisfy the supply need that's out there. It seems like it would be setting up for a little bit more short-lived, outside of maybe some weather events for now. That's the update I got, and that's from like last week. So I haven't followed up on the coffee market or the cocoa market in about a week and a half.
Yeah, not much has changed. Like, that's the thing. Not much has changed, and the thing also with the softs, and this is why when Kevin just said, "Hey, it doesn't really need much to really move these markets." The softs, there's not. This is why I also like these type of commodities. There's the big three. You have the gold, you have silver, you have oil. Everybody knows those ones. Everybody pays attention to those ones. Even copper. But when you get really out there in commodity land, there's not news every single day. There isn't, coffee, the outlook isn't going to change every single day. Sure, I could look at the weather patterns, I can come up with ideas every single day, but there isn't some massive news flow that's going to come out every second and change the trend. To where, you have all these pullbacks within an uptrend. This is the reason why, if you actually back test it, and I think his name was Perry Kaufman. I read his book years ago. He's a guy who creates a bunch of systems, but he did a bunch of back tests and found out that equities are very mean reverting, commodities are not, and the reason is the news flow. And so, like, when you're looking at equities, you can kind of come up with mean reversion systems that make a lot of money. In commodities, it doesn't work exactly the same way because of that news flow. And if you backtest it yourself, you find out that that's the absolute truth. For example, if you run a 4 days down system, which actually works really well, a lot of professionals use this type of system in the S&P 500, whether you're selling spreads, selling puts, whatever you're doing. Basically, on the 4th day down, you would sell a put option or a put spread, or yeah, and basically after you would put on that spread, you would make money on the price going up a little bit, and it goes up for a few days. Usually, it doesn't hit that low anytime soon. Very high win rate. I think it's over 78%. But if you go the other direction and you do that in oil, if you just buy a contract when it's 4 days down and try to hold it,
Yeah.
you're going to get smashed. Usually oil just continues to trend. And when you look at it even further out, like in something like coffee, that's going to be even worse. So kind of an interesting thing to think about for all you systems guys, building systems. Look at it a couple different ways. Some people go trend following is great and it's the perfect thing for everything, and other people go mean reversion is the perfect thing for everything. There's a time and place for every type of trading style. So, but yeah, so getting into that, let's move on. Is there anything else you're thinking of, Kevin, that people should be looking out for in the week ahead?
Natural gas would be the only one that I also have on my radar here today. A wide-ranging activity here today. It traded down to 207, but last week I believe it crossed that $2 level. It tested it. It tried to. So I'm keeping my eye on Natty. So we've been talking about it for like 2 months now. So you'll start hearing me talk about it when we get closer to the seasonal. This is the time. This is the time where we're like, okay, what does this look like? Now, just be mindful. Inventory levels when you're looking at the European Union are looking good. The injection season for them has been a little bit light over the last, let's say, 3 weeks, 4 weeks. So be mindful of that. But their inventory levels are looking decent. Us here in the United States, we're looking decent. You can always play that winter risk of like weather, but there's also winter geopolitical risk, because a lot of the advances, for people that don't understand, a lot of the advances for the Russian army when it comes to Ukraine is actually not really done during the summer months. It's actually done in the winter. That's when things freeze over, rivers freeze over, they can move a lot of equipment, and that's where they thrive. And it does appear that they're ramping up attacks on Kiev and a lot of other different areas here. I still believe that there's an existential risk that's out there for natural gas, and higher demand will come for LNG. And so there's that seasonal play that you can make. Now, am I saying it's going to hit $3 or $4? If I don't know about that. I'm not sure about that. But I would say that the risk reward right now is starting to tilt. It should start tilting. Let's say that should start tilting in the favor of the bulls for natural gas. And we kind of talk about how do you play that? Example, not a recommendation, but an example. You buy further out call contracts, sell near dated, in order to try to reduce that cost basis. Now, until you actually have that spike in price and that diagonal, or even if you do a calendar spread, kind of gets maxed out, it's a way for you to be able to try to chop away at premiums until that setup actually really does foment itself. But I think this is kind of that seasonal trend. Now, there is like a structure that we are seeing right now where it's still below the resistance level. Resistance is sitting at 225, let's say 230. Let's say 230. Right. And I am not a breakout guy at all. Like you know that. But like this would be that setup where like, okay, if it breaks above 230, strong volume, and you have a thesis there, maybe it can continue to trend higher. But that's the one I've been kind of like eyeballing. It's been consolidating over the last 2 or 3 weeks. And even with some of the bearish fundamentals when it comes to inventory levels here in the United States with the EIA data, price hasn't really gotten shaken out too much. So I think the market might be primed for seasonal positioning for Natty. What do you think?
No, I agree. I mean, it's really interesting when you get back to natural gas and you go all the way back. Like people should really go to the charts, look through natural gas historically getting to this point of the year. You see these massive pops once in a while because basically everybody gets, and funds do this for sure. I used to work with a guy who did this constantly. Basically, you just short it all year long. You short natural gas all year long. You short every pop. You either buy or you sell call options. Whatever you do, there's a bunch of ways to continue to short it. And basically, by this time of the year, people forget about those seasonals, and they forget that natural gas can move up just as well as down, and short interest gets so big on one side of this that you have this massive pop that usually happens around now through October, even into November. Sometimes it happens in the winter, but either way, I would be once again, natural gas can do whatever it wants to do. That's something to always keep in mind. It is the exorcist of trading. It will do it will do whatever it wants to do. Its head will spin around and spit blood at you. I have no idea what it's going to do tomorrow, but it can make you a lot of money because this thing moves in a very big way sometimes. So respect it, size small, but at the same time, understand that this move will probably happen at some point within the next few months, and be ready for it.
Agreed. Yeah, it's a tough trade. It's a tough trade, but once again, if you're looking at the risk rewards,
you got to look at the risk reward.
Yeah,
and really, don't be afraid to take shots. Don't be afraid to take shots.
Right. I don't know, man. I feel like the geopolitical stuff just across the board. You never make a trade thesis off of this. Okay, you never, not as your sole one. For instance, if I saw gasoline demand still rising to the upside, production levels for the most part stabilizing, and we also are seeing a stabilization when it comes to inventory builds. If not, we maybe even see a draw. Then we're going to talk about oil here for a second, right? And we continue to see prices falling to the downside, and I see that's speculators shorting. And then you kind of look at it and say, okay, well, what's the IV looking like, or the implied volatility within the options curve for crude? And it's relatively cheap. You have to think to yourself, okay, maybe it's underpriced, right? That people call it like dispersion in some respects. It's just like a fancy name of saying there should be something that actually has to correct when it comes to pricing because valuations are not aligned. And so I feel like that's still there for a lot of these geopolitical risk items. And then the election season stuff. And I'm not saying the world's going to end by any stretch of the imagination here, but I feel like for Natty, I mean, man, it just seems like there's a lot that's there. You have a country in Ukraine that has a significant amount of leverage right now to be able to cut off flows to Europe. Now they would be biting the hand that feeds them. But if they needed a lever to impact Russia, they could do that, right? And then you have the other side of it where Russia's like doubling down and going all out. At some point, that infrastructure seems like that would be at risk. Those flows may be at risk. And so that's the way you kind of look at it and say, you got the seasonality, you got the bigger draws. Maybe that's going to be a player. Heating oil is another one too, even though like the thing, you never want to catch a falling knife, but heating oil or diesel actually does have winter applications, especially in the Northeast when it comes to heating for furnaces. So that actually, we tend to actually see outperformance from heating oil in the winter months compared to, say, gasoline or crude oil. Right, so there's certain setups that are there, but man, the geopolitical risk premium, in my opinion, is still really cheap. But you don't set up a whole trade on that, because if that was going to be the case, I would have been telling you it's been cheap for the last 5 weeks. I mean, we've seen these swings where it's like, hey, now it's cheap, and then like the next day it pops $4, right, for crude, and then it's like, get out, like that's it. Because that's what we're talking about. You're not talking about cheapness as being like a Russia-Ukraine huge spike for natural gas where it goes up to $9. It's nothing like that. But it's like these tactical positions where you get in, swing, boom, you get a buck, you get out. For natural gas, it's kind of like you get 30 cents a natty, head for the hills, right? Like that's a nice little profit there if you're trading a one lot. If you're trading the contract or if you're trading the options, right? Boom, you get up until it sets you up again. Boom. And then, crude's the same way. Crude right now, if you're being completely objective and you looked at the chart and you didn't tell me this is crude oil and you looked at this trend, you would say, man, either this thing is going to break down, which you look at near-term area support at around $67, $68. You could say, okay, that's a lot of money. right? You're talking about $3.5, give or take, $3. $3 on one crude contract is $3 grand. You don't, there's nothing to scoff at when you're trading. But then you kind of look at it and say, man, but these things have been reverting. If you look at I'll leave it at this. If you look at the highs and lows on crude, I'm not sure if we have a chart of this, but if you have a high to low for crude, you'll notice that the range intervals obviously making lower highs and making lower lows. But you'll notice that the retracements are hitting right at the 61.8% retracement level. Now, fibs, you don't want to die on that sword either. But if you kind of notice that price correlation, and we're making a new low right now, especially hitting a critical area of $70, what could happen? Maybe a 68% retracement of the high to low move, which the high to low move between $70 and say 77 and some change, you're looking at a 50% retracement level. I'm spitballing this. 50% retracement level, $3.50 off the low. So what, $73.50 would be your 50% fib. And if you're looking at 61, that would be around 74 and some change, 74 and a half. And then put your downside target at 70, or not 70, maybe because you never want to be on the actual level, right? Like if it's $70 is your area of support, you want to kind of be a little bit below that, because every market maker and their mother is going to swipe out any type of stops that are sitting at 70.
Yep.
So even if you look at it 69 and some change, 69.80, risk reward. That's how I look at it.
No, perfect. And we're going to end it there. Thank you guys for joining us. We'll be back next week on Monday at 11 a.m. And if you guys also want to check out the Holy Macro Show, we have Kevin Muir from the Macro Tourist on Friday at 2:15. All right, guys. Thank you guys so much. Make sure to follow the speakers. Make sure to follow Kevin, KG Bull and Bear. And we'll see you soon.